Welcome to the Deep Dive, where we cut through the noise of earnings calls to bring you the vital insights. Today, we're digging into NTIC's third quarter fiscal 2025 earnings, a really close look at how this specialty chemical company is navigating its current market.
Exactly. And our mission here is to unpack the key financial figures, dissect what management said about their different business units, and explore, the broader implications for the company's path forward. It's all about getting you informed quickly, maybe with a few surprises along the way.
All right, let's get right to it then. A quick snapshot of the headline numbers. NTIC reported a 4.0% increase in total consolidated net sales for Q3. That at $21.5 million. So you've got growth both sequentially and year over year there, which is solid. And what really jumped out at me, at least, was the gross margin. Climbed nicely to 38.4%. That's an increase from the prior year, too.
Yeah, those top line numbers and the margin look pretty healthy on the surface. But this is the interesting part. Net income and the non-GAAP adjusted figure, they saw a significant year-over-year decline for the quarter. We're talking $122,000 for net income. That's just 1 cent diluted EPS, earnings per share. And $228,000 non-GAAP, so 2 cents diluted EPS.
Right. So the core puzzle here is what's driving this gap, between sales going up and profitability. Well, not. Is this just the cost of growth like you sometimes see, or is it pointing to maybe a deeper issue?
That's the big question, definitely.
Okay, so let's peel back the layers. Let's dive deeper into the financials, the operations, see what's going on in the business units. First up, sales. It was kind of a mixed bag across their segments, wasn't it?
It really was.
Xero's Industrial's net sales increased by 7.1%. That's pretty strong. But then Xero's Oil and Gas and Nitrate actually saw slight decreases, 5.3% and 1.2% down, respectively. What does that mix tell you about the overall demand picture for NTIC?
Well, it tells us they're not exactly riding a uniform wave here. Xero's Industrials clearly has some momentum, good demand in that sector. But the little dips in oil and gas and Nitrate, that suggests maybe specific market challenges, or perhaps, like management hinted, it's about where they're choosing to focus strategically right now.
Interesting. And despite that mixed sales picture, the gross margin strength at 38.4%, it really stands out. You mentioned it was up year over year 20 basis points or 0.2%. What drove that? How did they make more profit on each sale?
Management pointed to two things. One, a more profitable mix of sales, so selling more of the higher margin stuff. And two, ongoing efficiency efforts, basically keeping costs tight where they can. It's definitely a good sign they can, pull those levers on the cost side, even when things are a bit tough.
Okay, but then let's look at the other side of the coin, the operating expenses. Total OPEX increased 7.6% to $9.7 million. That's what, almost 45% of net sales, 44.9 to be exact.
Yeah, that's a pretty hefty chunk.
And the company said this was mainly increased personnel costs and these strategic investments, especially they called out oil and gas. What should we make of expenses going up that much?
It's critical, right? Management is framing these as strategic investments, necessary spending for future growth. But, you also have to look at the balance sheet. That revolving line of credit went up. So how much of this strategic investment is truly funded by operations and how much is basically borrowing? That's something investors need to watch long term. Spending to grow is one thing. Borrowing heavily while profit shrinks, that's another calculation.
Yeah, good point. And speaking of challenges, their joint ventures, those aren't consolidated in the main numbers, but JV sales saw a big drop, down almost 13% year over year to $2.3 million. And JV operating income fell too. Management is blaming high energy prices, regional economic pressures in Europe, and even uncertainty about U.S. trade policies. So Europe's definitely a drag right now.
Absolutely. Europe and the JVs, that's a significant headwind for them. But management was pretty explicit. They said, yes, macro pressures and higher OPEX hit profitability in Q3. But they anticipate things improving in Q4 and making more progress in fiscal 26. So they're essentially telling us, look, trust the process. These expenses are part of the plan. They're setting us up for future gains. They see this dip as temporary.
Okay, that brings us to the balance sheet and cash flow then. Let's look closer. Working capital was $21.7 million. That included $6.8 million in cash, but outstanding debt was $10.1 million. And the key part there is $7.4 million was drawn on their revolving line of credit. That's up quite a bit from $4.3 million previously.
Right, a noticeable increase.
And they said a strategic focus is reducing this debt through positive operating cash flow, which was $3.8 million for the first 9 months. They also temporarily adjusted the quarterly cash dividend down to just 1 cent per share. Part of disciplined cash management, they called it. Cutting the dividend, taking on more debt, that feels like a pretty clear signal, doesn't it?
It's definitely a strong signal, yeah. It says they're prioritizing keeping cash in the business and funding these investments over immediately returning cash to shareholders via dividends. They're clearly in reinvestment mode. Not necessarily bad, but it really underscores that point about how these strategic investments are actually being funded.
Okay, let's shift gears a bit beyond just the pure financials. Let's explore the individual business segments. This is where you can really see where management is putting its energy, where they see future growth. NTIC China, for example, that looked really impressive. Sales up 27.4%, hitting $4.5 million. That's its second highest quarterly revenue ever, I believe.
Yeah, a very bright spot.
And the key thing they mention is that most of these sales are for domestic Chinese consumption. That limits their exposure to U.S. tariffs, right? They expect China to become a really significant geographic market. And it's profitable already, contributing positively.
It is a very bright spot and strategically important, too. That domestic consumption angle is crucial, like you said. It gives them a buffer against those trade tensions. It makes NTIC China feel less like just some side venture and more like a core engine for growth, especially if their expectations play out.
Okay, now Zero's oil and gas. We mentioned the quarterly sales dip earlier, but they pointed out that trailing 12-month sales were actually up 15.4% to $8.6 million. And they're making those strategic investments we talked about, building up the sales team, resources. They even quantified it. Said the extra cost for this personnel push is about $1.3 million over 12 months, so roughly $340,000 a quarter.
Right, they're putting real money behind it.
And the pitch for the tech itself is that it's cheaper upfront to install and performs better long-term than traditional methods. Plus, they're expanding. Middle East, South America, Africa. So is the narrative here sort of short-term pain for long-term gain?
That's definitely the story management is selling. They're investing heavily in the sales infrastructure for oil and gas because they believe the tech has a strong value proposition that will win out eventually. Expanding globally like that just underlines their ambition for the segment. It's a calculated gamble, really, on future revenue.
And then there's Nitrate Bioplastics, saw a sequential rebound in sales, which is good. And obviously there are strong long-term market opportunities there driven by all these local and state organic waste diversion mandates we keep hearing about. But I'm really curious about the new developments, the compostable plastics breakthrough potential. They've been working on this issue with the high water vapor transmission rate permeability that's limited compostable packaging, especially for food. What's the latest there?
Yeah, this could be the really exciting part. A potential game changer, honestly. They believe they've actually found a solution in the lab. And crucially, they're moving towards scaling it up for production. And it's still an if at scale. But if they can solve this permeability problem properly, it could just unlock enormous market share in food packaging. I mean, think about it. The whole industry is desperate for sustainable packaging that actually works like the old stuff. Functional, genuinely compostable. They're talking about significant revenue impact within the next 2 years from this.
Wow. Okay. So stepping back then, broader implications. What does this all signal for investors, for you listening? We've seen this mixed bag, right? Strong sales growth, good gross margins, but then this dip in profitability because of investments in those macro pressures, especially in Europe. Management clearly frames it as strategic. But like you said, looking at the numbers, that rising debt, the dividend cut, that might make people nervous. How do you square that strategic investment story with those financial pressures?
It really highlights that dual focus you mentioned. They're trying to navigate the immediate headwinds, Europe hitting the JVs, while at the same time making these pretty significant planned investments they hope will drive long-term growth. They are watching for stabilization signs in Europe. They expect stimulus, especially in Germany, to help the JV income eventually. So they seem committed to this multi-year growth plan, focusing on profit eventually, even with the current bumps. The key signal for investors, I think, is trying to figure out if this profit squeeze is truly temporary, just part of the investment cycle and macro factors, or if it hints at something deeper, maybe more systemic.
Okay, that leads us perfectly into the segment where we stretch the bounds of the plausible a little. This is not financial advice. These are speculative ideas. Pitch like you're talking to an investment committee. Go for it.
All right. Given everything we've just talked about, my outrageous but plausible trade idea for NTIC, it centers squarely on that compostable bioplastics breakthrough. The pitch is this. A long position using long-dated, out-of-the-money call options on NTIC, betting on that big future upside.
Okay, so betting big on the upside, far out. How do you fund that? What's the other side?
To potentially finance that, I'd look for a short position, maybe in a legacy, non-compostable food packaging manufacturer, one that stands to lose if NTIC succeeds. The core thesis is, if NTIC's claim about solving that water vapor issue is real, if they can scale it and commercialize it, that's not just an improvement, it's a fundamental disruptive shift for the whole food packaging industry. It could unlock massive market share in a sector that's just crying out for sustainable solutions that actually work.
That's a bold call. So what makes it outrageous in your pitch and what makes it plausible?
Well, the outrageous part is definitely the timeline. 2 years for significant revenue. That's fast for this kind of tech. And the technical hurdle of scaling up is huge. Never underestimate that. It's sort of like, building that rocket on a tight deadline while everyone's already demanding warp speed. But the plausible part, that lies in the sheer force of regulatory pressure and consumer demand for genuinely compostable materials. That wave is building. If they actually pull this off, the market won't just see them as another specialty chemical company. They'll be re-rated as a leader in sustainable packaging. And that re-rating, that's where the potential for massive value creation comes from in this trade idea.
Okay, interesting angle. So to wrap things up then, NTIC delivered top-line growth, strong gross margins in Q3. But profitability definitely took a hit, seems driven by strategic investments, particularly in oil and gas, and those ongoing macro headwinds, especially dragging on the European JVs. Key areas we'll be watching. That continued robust growth in NTIC China, how quickly Zero's oil and gas ramps up with the new investment, and of course these really exciting, potentially disruptive developments in Nature-Tech bioplastics.
Exactly. And ultimately the big question, I think, for you listening is, how much weight do you put on management's long-term vision, on these promising growth stories, versus the immediate profitability pressures, the rising debt we discussed? It's that classic investment dilemma, isn't it?
Mm-hmm.
Growth, but at what cost right now? What signals should you be looking for next quarter or the quarter after that tell you if these investments are truly starting to pay off? That's maybe something for you to consider as you digest this deep dive.